On September 25, Charles Schwab announced significant share splits for several of its major ETFs. And among those ETFs, SCHG, SCHD, and for example SCHB are included. This includes their bonds, small caps ETFs, and even international ETFs, where some undergoing a 4 to 1 split ratio and others a 3 to 1 or a 2 to 1 split. What does this ETF split mean for you? In this video, we will tell you the pros and the cons and the answer if you could benefit from this ETF split. So if you are following me for a longer time, you know I'm personally a big fan of SCHD, the Schwab U.S. Dividend Equity ETF. Why? It boasts an impressive track record over the last 10 years, not only for its dividend growth, but also for its price appreciation, delivering a total return of about 11.7% each year, which is awesome. And the best part about SCHG is its attractive dividends, making it an excellent choice for retirees, for example, seeking a stable cash flow. Moreover, in a low interest rate environment, it provides a reliable stream of income, which is great. So, to put this into perspective, if you invest, for example, $600 per month for 35 years at an annual interest rate of around, let's say, 10%, you would end up approximately with $2.2 million. And this is the power of compound interest, your secret weapon. But the best part is that if the dividend yield remains the same around 3.6%, you could generate over $82,000 per year in passive income. And even better, the fund would continue to grow each year, allowing you to earn even more in dividend income annually. And this is one of the reasons why I'm a big fan of this fund, and also due to its stability during market downturns, something I discuss in this video. So yes, SCHG is high on my list, and with the upcoming ETF split set for October 10th, it's an ideal option to dive deeper in this topic. Because the most asked question is, Maurice, what will happen after the split later this week, and does it have any negative consequences for my portfolio? So let me explain. An ETF split, similar to a stock split, occurs when an exchange traded fund, an ETF, divides its existing shares into multiple new shares. For instance, in a 4 for 1 split, each existing share is split into 4 shares. If you owned 1 share before the split, you owned 4 shares afterward. So let's put this into a simple example, and let's take the current share price of SCHD, which is current $84 per share. If they split in 3, each share will become 1/3 of the price, resulting in $84 divided into 3, which equals $28 per share. But what about the value of your portfolio? Does it decrease as well? And that's a great question. And no, the total value of your investment remains the same. So, for those of you who hold SCHD at this moment, let me explain this with a little example. Let's say you have 1,000 shares at $84. This means you have $84,000 worth of SCHD, right? After the split, you would have 3,000 shares instead of 1,000 shares at $28. And your total value stays the same at 3,000 at $28 is $48,000. So you just have more shares and the price per share is less, but the total amount remains the same. Easy, right? So what could be an advantage of this ETF split? Well, not much changes overall, but a key advantage of an ETF split is that it makes the fund more accessible to a broader range of investors, which can be a significant benefit. Let me explain. Lower price shares are often easier for new investors to purchase. The fact that SESG price will be closer to $28 instead of $84 can make a noticeable difference for many investors. Many investors that are new to the market tend to avoid investing ETFs in stock prices above $50 because it can be challenging to gather that amount. They often prefer to buy shares in smaller increments, allowing for more effective portfolio diversification. Secondly, splitting shares can lead to increased trading activity and liquidity. More shares at a lower price can attract more buyers, potentially enhancing trading volume. Importantly, a split does not change the overall market capitalization of the ETF or the value of the underlying assets. You still own the same proportion of the fund's assets, just divided among more shares. But Maurice, what about the underlying assets? Does it change anything? In the case of Schwab's ETF Split, it's essential to remember that an ETF tracks underlying assets, which are the companies within the fund. The ETF's value fluctuates based on the performance of these companies. Even though the ETF will be cheaper, the value of the underlying assets remains unchanged. And what I've said earlier, another important aspect to consider is that SCHD is an excellent dividend provider for investors. While the total dividend payout remains the same after the split, the dividend per share will decrease proportionally. For instance, if a fund paid $3 in dividends per share before a 3-for-1 split, it would pay $1 per share afterward. So for long-term investors, an ETF split shouldn't significantly alter their investment strategy. However, it may create an opportunity for new investors to enter the market or for existing investors to acquire more shares at a lower price. So if you are wondering why SCHD ranks high on my list and why I believe it could be a game changer in 2025, I'm here to explain everything in this video. I will share 3 compelling reasons that support my perspective. And by the end of this video, you will likely see why you should consider SCHD for your investment strategy as well. See you in the next video.